Number 2, protecting your money. Protecting your money from financial predators is important. As most of us know, the world is filled with people waiting for the opportunity to help themselves to your money. Many of these people are very smart and powerful. If they are smarter than you or have more power than you, they will get your money. This is why financial IQ number 2 is so important. How do you measure financial IQ number 2? Financial IQ number 2 is measured in percentages. Here's what I mean. The following are 3 examples of 3 different percentages. Number 1. In America, a person who earns $100,000 a year from wages may pay as much as 50% in combined taxes, such as federal, state, and FICA. This person's net after-tax income is $50,000. Number 2. Another person earns $100,000 income from their investments and pays 15% in taxes. This person's net after-tax income is $85,000. Number 3. A third person earns $100,000 income and pays 0% in taxes. This person's net after-tax income is $100,000. In the examples above, the person who pays the least percentage in taxes has the highest financial IQ number 2, protecting your money, because less money is lost to financial predators. In later chapters, I will go into how to earn a lot of money and pay nothing in taxes legally. But for now, keep this simple idea in mind. Financial IQ number 2 measures the percentage of income a person keeps against the percentage of income financial predators take. Bunnies, birds, and bugs. Rich Dad's lessons to his son and me on the importance of protecting money from financial predators started at a very early age, before we had any money. Because we were young, Rich Dad used a very simple example of farmers to make his point. He said a farmer needs to protect his crops from bunnies, birds, and bugs. Bunnies, birds, and bugs are thieves to a farmer. Continuing on with his bee theme, Rich Dad's list of real-world financial predators included bureaucrats, bankers, brokers, businesses, barristers, brides, beaux, and brothers-in-law. The first B, bureaucrats. As we all know, taxes are our single largest expense. The job of the tax department is to get your money and to turn it over to a government bureaucrat who spends it. This is one reason why financial IQ number 2 is so important. You cannot become rich if all the money you make is taken from you by financial predators. Taxes are important. Before going on, I need to say that I am not against the government or paying taxes. Rich Dad said, taxes are an expense for living in a civilized society. He pointed out to his son and me that taxes pay for schools and teachers, fire and police protection, court systems, the military, roads, airports, and the general operation of the business of government. Rich Dad's frustration with taxes was that bureaucrats very rarely solved the problems they faced, which meant taxes had to keep going up. Realizing that we will only pay more in taxes, Rich Dad's philosophy was, a bureaucrat's job is to get their hands deeper in your pockets legally, and your job is to have them take as little as possible legally. Which political party is better? Just so you know, I am not Republican or Democrat, conservative or liberal, socialist or capitalist. When asked, I simply reply that I am all of the above. For example, as a capitalist, I want to make a lot of money and pay as little in taxes as possible. As a socialist, I make tax-deductible donations to charities and worthy causes, and I want my taxes to provide for a better society and care for those who truly cannot care for themselves. Many people believe that Republicans are better than Democrats when it comes to money. The facts do not support their belief. Republicans say Democrats tax and spend. Republicans, on the other hand, borrow and spend. The net result, regardless of party, is increasing long-term national debt, a debt that will be passed on to future generations in the form of higher taxes. In 1980, Republican President Reagan gave us supply-side economics, that is, voodoo economics. The new economic theories promoted by the great communicator Reagan, an actor, not an economist, were the illusion that we could cut taxes and continue to pay the government's bills by borrowing money. This is the same as taking a cut in pay and using credit cards to pay bills. When Thomas Gale Moore, then a member of President Reagan's Council of Economic Advisers, noticed that the United States was crossing the creditor-debtor threshold in the mid-1980s, he said not to worry, we can pay off anybody by running a press. Because of the 1971 change in our money and Reagan's supply-side economics, the national debt of the U.S. exploded. By the end of Reagan's reign, the federal debt was $2.6 trillion. President Reagan's vice president, the first George Bush, realizing the national debt was exploding due to the loss of revenue from Reagan's tax cuts, ran for president promising, "Read my lips, no new taxes." After he was elected, he raised taxes and was not reelected. Then President Clinton, a Democrat, entered office. After having a little trouble with his zipper, he left office claiming to have balanced the budget and not increased the national debt. Of course, just as he lied about his sex life, he lied about balancing the budget. He balanced the budget by counting tax dollars for Social Security and Medicare as income. Instead of the money going into the Social Security Trust Fund, he spent it. Clinton, however, did speak one truth during his term of office. He admitted that there was no such thing as a Social Security Trust Fund. During his presidency, Medicare began to operate in the red, meaning more money was going out than coming in. Soon, Social Security will be in the same predicament as 78 million baby boomers begin to retire in 2008. Enter the second President Bush. Uniting the world after 9/11, he then used his popularity to wage war against Iraq on unsubstantiated claims. Today, he is one of the most unpopular presidents in history. Not only was the war a disaster, but in order to prevent a disaster in the economy, the Federal Reserve Bank cut interest rates and flooded the world with funny money under his watch. After just 5 years in office, President Bush has borrowed more money than all U.S. presidents in history combined. The current subprime crisis is the fruit of his economic policies. All of this is to say, it doesn't matter which party is elected into office. If it's Democrats, they will probably tax and spend. If it's Republicans, they will probably borrow and spend. The net result is the same: greater debt, bigger financial problems, and higher taxes. All funded by taking as much of your money as possible. The second B, bankers. Banks were created to protect your money from bandits. But what if you found out your banker was a bandit? What if you found out that the very people you entrusted with your money were siphoning off more money than you knew about, and doing it legally? While he was New York Attorney General, New York Governor Eliot Spitzer investigated a number of investment banking firms and large mutual fund companies, finding them guilty of several illegal practices. The very people the public entrusted with its money were skimming a little more money than they should have been. The guilty companies were fined a trifling amount compared to the dollar amounts they took. While the paltry size of the fines is disturbing, what is even more disturbing is that these bankers are still in business today. The problem is that Eliot Spitzer's investigation was limited to investment banking firms in New York City. The problem of bankers taking money from innocent customers is a worldwide one. As more businesses stop caring for workers for life, more workers are forced to save for their own retirement. Workers do not have the money to hire professional financial services like businesses do. This is causing the pool of financially naive money to grow like a hot air balloon, making bankers and people who sell financial services to workers grow richer and richer. Today, workers' retirement funds are fueling a global economic boom. Retirement funds are an ocean of money, unprecedented in world history, guarded by bankers, not you. The third B, brokers. Broker is another word for salesperson. In the world of money, there are brokers for stocks, bonds, real estate, mortgages, insurance, businesses, etc. One of the problems today is that most people are getting their financial advice from salespeople, not rich people. If you meet a rich broker, you need to ask if the broker got rich from his or her sales ability or financial ability. As you know, there are good brokers and bad brokers. Simply put, good brokers make you richer, and bad brokers make excuses. The following is an abbreviated list of things that helped us find and keep good brokers. We look for brokers who were also students of their profession. We want to know if they invest in what they sell. After all, why should you invest in what they're selling if the broker doesn't have the confidence to invest in the same stocks? We wanted a relationship, not a transaction. Many brokers only want to sell. The fourth B, businesses. All businesses have something to sell. If they do not sell, they are out of business. I often ask, is this business's product or service making me richer or poorer? One of the reasons so many struggle financially is they buy products that make them poorer, and then make themselves even poorer by paying for that product for years with high-interest credit cards. If you want to be rich, become a customer of businesses that are dedicated to making you richer. For example, I am a long-term customer of a number of investment newsletters and financial magazines. I am also a customer of businesses that sell educational products and seminars. In other words, I am a good customer to some of my competitors. I like spending money on products or services that make me richer. The fifth B, brides and beaux. We all know that some people marry for money. Both men and women marry for money rather than love. Like it or not, money plays an important role in any marriage. Rich Dad called people who marry for money love predators. The more money you have, the more they love you. In his much-publicized divorce, Paul McCartney may have to give up 50% of his estimated $1 billion estate. That is a lot of money. This shows that McCartney has earned a lot of money as a musical genius, but his lack of financial IQ number 2 is costing him a lot of money that a little premarital planning might have saved him. The sixth B, brothers-in-law. Death is the final exit. It is another time when predators appear, or I should say, vultures. If you are rich, not having a financial IQ can be expensive for your loved ones. Your brother-in-law's grandchildren, children you've never met, suddenly become family and come to cry at your funeral. If you have a high financial IQ, the percentage of your money these grieving relatives receive will be controlled by you even after you have moved on. Those with a high financial IQ have wills, trusts, and other legal means of protecting their wealth and final wishes from death predators. The seventh B, barristers. You may remember the person who sued McDonald's claiming the coffee was too hot. That is an example of a financial predator using the court system to get your money. Millions of people are waiting for any excuse to use a lawsuit to get rich. This is why the seventh B is for barristers or lawyers. There are lawyers whose sole purpose in life is to take you to court and take your money. Knowing these predators are lurking, there are 3 things a financially intelligent person must do. Keep nothing of value in your name. It was my poor dad who proudly said, "My house is in my name." Financially smart people would not have their houses in their names. Buy personal liability insurance immediately. Remember, you cannot buy insurance when you need it. You must buy it before you need it. Hold assets of value in legal entities. In the U.S., the good legal entities are C corporations, S corporations, limited liability corporations, LLCs, and limited liability partnerships, LLPs. There are also bad legal entities. These are sole proprietorships and general partnerships. The rules have changed. As you know, in 1974, workers needed to become investors saving for their retirement. This gave rise to the 401k. The problem with a 401k is that the government plugged this loophole for workers too. Let me explain. When a person works for money, his or her income is taxed as earned income, the most highly taxed income. When a worker withdraws money from his or her 401k plan, that income comes out as, you guessed it, earned income. Guess what interest from savings is taxed at? Once again, earned income. This means a person who works hard, saves money, gets out of debt, and saves for retirement in a 401k plan is working for the most highly taxed income, earned income. This is not financially intelligent. People following these rules demonstrate a low financial intelligence because they give away a large percentage of their income. A financially intelligent person does not want a big paycheck. A financially educated person would rather be paid royalties or dividends because taxes are lower on these types of income. A knowledgeable investor at least knows enough to invest for portfolio or passive income. Personally, I am not trying to change the system. My personal philosophy is that it is easier to change myself than to change the system. In other words, I am not a person who battles the winds that drive windmills. Hence, I am not politically inclined. I don't believe politics or politicians are effective against those who run the world of money. It seems that most politicians, in order to be elected, need to be pawns of the very people who control the world's money. Most financial advisors are employees of these world bankers. I simply want to know the rules and play by the rules. This does not mean I believe the rules are fair or equitable. They aren't. The rules of money are what they are, and they change regularly. Besides, this new world of money, even though unfair, has done a lot of good. It has brought tremendous wealth and new products to the world, raising the standards of living everywhere. Quality of life for billions of people is improving. Money has done a lot of good. Unfortunately, these changes have come at great expense to many countries, our environment, and many people. Many have become very rich taking advantage of the financially naive. Many have become rich by taking the wealth of others. This is why financial IQ number 2, protecting your money, is a very important financial intelligence. Ignorance is bliss, and that's what the financial predators are banking on, your ignorance making them blissfully rich. Chapter 5. Financial IQ number 3, budgeting your money. My poor dad often advised, live below your means. My rich dad said, if you're going to be rich, you need to expand your means. In this chapter, you will find out why living below your means is not a financially intelligent way to become rich. You will learn about budgeting and that there are two kinds of budgets. One is a budget deficit and the other is a budget surplus. The reason financial IQ number 3 is so important is because learning how to budget for a surplus is the key to becoming rich and staying rich. A budget is a plan. One of the definitions of the word budget is a plan for the coordination of resources and expenditures. Rich Dad said a budget is a plan. He went on to say most people use their budget as a plan to become poor or middle class rather than a plan to become rich. Most people operate their lives on a budget deficit rather than a budget surplus. If you want to be rich, choose a budget surplus and create one by increasing income, not reducing expenses. A budget deficit. I have a friend in Atlanta who makes a lot of money. He has to make a lot of money. If he stops making a lot of money, his money problems will eat him alive. He has chosen to create a budget deficit. Every time Dan makes more money, he either buys a bigger house, a newer car, or takes an expensive vacation with the kids. He has another bad habit. Every 10 years or so, he marries a younger woman and has a new child. Dan grows older, but his wives are always about the same age, 25. Dan is an expert at taking a lot of money and making his money problems worse through deficits. A budget surplus. The second financial choice is to plan for a budget surplus. After making money, financial IQ number 1, and protecting your money, financial IQ number 2, learning how to budget for a surplus is essential for achieving financial integrity. The following are a number of lessons I have learned from my rich dad and other wealthy people about budgeting for a budget surplus. Budget tip number 1. A budget surplus is an expense. This is one of the best financial lessons my rich dad passed on to his son and me. Pointing to the financial statement, he said, "You have to make a surplus an expense." In Rich Dad, Poor Dad, I wrote about the importance of paying yourself first. Most people know they should save, tithe, and invest. The problem is, after paying their expenses, most people don't have any money left to do so. In other words, most of the middle class's financial priorities are: priority number 1, get a high-paying job. Priority number 2, make the mortgage and car payments. Priority number 3, pay bills on time. Priority number 4, save, tithe, and invest. In other words, paying themselves first is their last priority. In order to create a budget surplus, a surplus must be a priority. The best way to make a surplus a priority is to reprioritize your spending habits. Make saving, tithing, and investing at least priority number 2, and list them as an expense on your financial statement. I know most of you can agree with the logic of what I am saying and agree that people need to make saving, tithing, and investing a higher priority. I also know this is easier said than done, so let me tell you how Kim and I handled this problem. Soon after we were married, we had the same financial problems many newlyweds have. We had more expenses than income. To solve this problem, we hired Betty the bookkeeper. Betty was instructed to take 30% of all income off the top as an expense and put that money in the asset column. Using simple numbers as an example, if we had $1,000 in income and $1,500 in expenses, Betty was to take 30% of the $1,000 and put that money in the asset column. With the remaining $700, she was to pay the $1,500 in expenses. Betty nearly died. She thought we were nuts. She said, "You can't do that. You have bills to pay." She almost quit. You see, Betty was a great bookkeeper, but she budgeted like a poor person. She paid everyone else first and herself last. Since there was rarely anything left over, she paid herself nothing. Her creditors, the government, and bankers were all more important than Betty. Betty argued and fought. All of her training told her to pay everyone else first. The thought of not paying her bills or taxes made her weak in the knees. I finally got her to understand she was doing us a favor. She was helping us out. I explained to her that she was helping us solve a very big problem, the problem of not having enough money. And as you know, solving problems make us smarter. When she understood she was actually creating income through expense, she was willing to go along with our plan to create a budget surplus. For every dollar of income, Betty would take 30 cents and put it in savings, tithing, and investing. With the 70 cents from every dollar left, she was to pay taxes, liabilities such as our mortgage and car payments, and then our bills such as electricity, water, food, etc. Needless to say, for a long time we came up short every month. There were some months Kim and I came up as much as $4,000 short. We could have paid the $4,000 from our assets, but that was our money. The asset column belonged to us. Instead of panicking, Betty was instructed to sit down with us and let us know how short we were each month. After taking a deep breath, Kim and I would then say, "It's time to get back to financial IQ number 1, making more money." With that, Kim and I would hustle around doing whatever we could to make more money. Kim, with her marketing background, often called businesses and offered to consult with them on their marketing plans. She also took modeling jobs and sold a line of clothes. I offered to teach investment or sales and marketing classes. For a few months, I trained sales teams at a local real estate company. I even made money by helping a family move and by clearing some land for another family. In other words, we swallowed our pride and did whatever it took to make the extra money. Somehow we always made it, and somehow Betty stuck with us and assisted us with our problem, solution, and process, even though she worried more about us than we did. Unfortunately, Betty could help us, but was unwilling to help herself. Last we heard, she retired and moved in with her single daughter. They share expenses, using Betty's payments from Social Security to pay them. They do not have a budget surplus. In 1989, Kim purchased her first rental property. She put down $5,000 and made $25 in positive cash flow per month. Today, Kim controls a multi-million-dollar portfolio and over 1,000 rental units. If we had not made investing an expense and paid ourselves first, we might still be paying everyone else first. God is our partner. As far as tithing goes, we continue to donate a large percentage to charitable organizations. It's important to give. As my very religious friend says, God does not need to receive, but humans need to give. Also, the reason we give is because tithing is our way of paying our partner, God. God is the best business partner I've ever had. He asks for 10% and lets me keep the other 90%. You know what happens if you stop paying your partners? They stop working with you. That is why we tithe. Budget tip number 2. The expense column is the crystal ball. If you ever want to predict a person's future, just look at the person's discretionary monthly expenses. Rich Dad said, "You can tell a person's future by looking at what they spend their time and money on." He also said, time and money are very important assets. Spend them wisely. Budget tip number 3. My assets pay for my liabilities. My poor dad believed in buying cheap. He thought being frugal was smart budgeting. We lived in an average house in an average neighborhood. My rich dad loved luxury. He lived in an affluent neighborhood and lived an abundant lifestyle. He did not like being cheap, although he was still careful with his money. If my poor dad wanted a luxury item, he simply denied himself the luxury of owning. He said, "We can't afford it." If my rich dad wanted a luxury item, he simply said, "How can I afford it?" And the way he afforded it was to create an asset in the asset column, an asset that paid for the liability. In other words, he acquired assets by paying himself first. With the cash flow from the assets, he then purchased his luxury liabilities. If he wanted big luxuries, he first created big assets. What many people do is buy big luxuries first and never have enough money to purchase assets. Again, it's a matter of priorities. The Bentley account. 2 years ago, I wanted a new car, a Bentley convertible. The price? $200,000. I had the money in my asset column. I could have purchased the car for cash. The problem with buying a $200,000 Bentley with cash is that the car is worth only $125,000 the moment I drive it off the lot. That is not a smart use of my cash. Instead of spending my cash, I called my stockbroker Tom and authorized him to convert some of my gold and silver shares into $200,000 cash. His job was to take the $200,000 and turn it into $450,000. The project was named the Bentley account. It took Tom about 8 months, but he finally called and said, "You can buy your Bentley." I then wrote a check and paid for the Bentley with the cash that had been created by my assets. The reason I needed the account traded up to $450,000 is because the extra $50,000 was to offset the taxes on the capital gains and the commission that Tom made. At the end of the day, I had my Bentley, and I still had the original $200,000. If I had just paid cash for the Bentley without trading the account, I would have lost my $200,000 in cash assets, and I would have lost an additional $75,000 due to the instant depreciation when I drove the car off the lot. In the chapter on Financial IQ number 2, Protecting Your Money, I wrote about how good brokers can make you rich and bad brokers make excuses. The Bentley account is an example of a good broker making me rich and happy, allowing me to afford the luxuries of life. So keep looking for a good broker if you don't already have one. At this point, it might be beneficial to remind you what an asset and a liability are. In my book, Rich Dad, Poor Dad, I define them simply as this. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. There's nothing wrong with enjoying liabilities as long as you continue to pay yourself first and purchase them through the income generated by your assets. In the previous example, I used my assets to purchase my liability, and at the end of the day, I still had my asset and my Bentley. Budget tip number 4, spend to get rich. When the going gets tough, most people cut back rather than spend. This is one reason why so many people fail to acquire and maintain wealth. For example, in the world of business, when a company's sales begin to drop, one of the first things the accountants do is cut back on spending. And one of the first things they cut back on is spending on advertising and promotion. With less advertising and promotion, sales drop, and the problem gets worse. One sign of high financial intelligence is knowing when to spend and when to cut back. When Kim and I realized we were in trouble, instead of allowing our bookkeeper Betty to cut back and pay bills first, we went into full-scale sales, marketing, and promotion. We spent time, money, and energy increasing our income. The lesson my rich dad taught me about financial intelligence is really about being resourceful. He taught his son and me to be resourceful and turn problems into opportunities. He said, "When I was a kid, I was poor. I am rich today because I saw being poor as an opportunity, a very important resource God gave me to use to become rich." Financial IQ number 3, budgeting your money, like financial IQ number 2, protecting your money, is measured in percentages, the percentage of income that reaches your asset column. If taking 30% of your income is too hard, then start with 3%. For example, if you earn $1,000, instead of allocating $300 or 30% to your asset column, then direct 3% or $30 toward your asset column. If this 3% makes life harder, that's good. A hard life is good if it makes you more resourceful. The higher percentage you direct to your asset column, the higher your financial IQ. Today, Kim and I direct approximately 80% of our income directly into the asset column and do our best to survive on 20%. Also, we never say we cannot afford it, and we refuse to live below our means. By continuing to keep things challenging, we become more resourceful, creating a more abundant life and a budget surplus.